which lenders will allow you to use the seller's money, aka a seller's second, in lieu of down payment. I want to get to that in a second. But first, let me set this up by saying 2025, it feels like there's a lack of liquidity in the marketplace, even though there's a ton of liquidity. The issue is that the prices, the values of things selling have not come down. Debt servicing, because of the cost of capital, is still restrictive, meaning for lenders to lend you the money, you, the borrower, needs to come up with more down payment instead of a 70-30 or 75-25 split between the lender and you. It's more like a 60-40 or a 55-45. There's a lot more capital needed from the borrower in the form of down payment to be able to make the loan debt service based on today's cost of capital for the borrowers. So you may be thinking, well, hey, I'll just have a seller carry the second because I don't have to bring it that much more money, down payment. Well, hold on one second. Depends on which type of lending you're getting. So let's just go through this real quick, and I've got some images for you that'll be in the video to show you which ones are going to do it. So let's just start with the beginning, which is CMBS, commercial mortgage-backed securities. Securitization, not going to happen. No seconds allowed there whatsoever. SBA, yes, you can do SBA. Bank financing, yes. Credit unions, yes. Life insurance, no, not going to happen. Unless it's a bridge loan, then maybe. Private funds, debt funds, family offices, that's a yes or no. Depends on which group it is. They can get creative with you, which is good, but also be very restrictive. Now, for those that actually allow you to do have a seller take a second, the first lien holder, the senior lien holder, who that's going to be, SBA, bank, credit union, whatever, will require 10% of that amount down. So yes, it does lower your amount to the table, but you still need to bring money to the table. Sorry, Brand Turner, love them to death, bigger pockets, all that stuff, but guess what? There's no 100% financing anymore that you want. So you can get it, but it's very, very rare. And just because you can get it doesn't mean you should get it. So be prepared to bring 10% down. The seller can take back, 20, 25, 30, whatever. Senior lender is going to be at, 65, 70% of the overall purchase price. That is good. Now, in lieu of that, there's other alternatives such as mezzanine debt. You've got C-PACE financing. We can cross-collateralize assets. If you have equity in other properties, we can bundle them all together into one and use the equity of those properties as down payments for the other ones. Or just go do a capital raise, such as a private placement or a JV. So there's some options for you to bring capital to the table. The biggest thing right now from lender standpoints is does the property cash flow on its own based on that loan amount? It's just a math problem. So if you're lacking liquidity, go check those things out, but do not just assume that you can go have a seller carry a second to be able to make the deal work. Oh, and by the way, if you do get them to work and the lender wants the senior lender will allow it, guess what? That senior lender will actually factor in the terms of that second loan for their overall global debt servicing. So watch your terms. If you need more help, reach out. Got more videos coming, and obviously feel free to submit questions. Happy to answer for you.